Let's bring in Bill Lee, Chief Economist and Executive Director at the Milken Institute, joining us from their Asia Summit over in Singapore. Bill, good morning, and I'll try and speak over the noise. I know it's fairly lively there where you are. Will the Fed drop and give us 50?
Well, the Chair Powell has been very famous for being opaque about how he's doing things. He's been keeping things close to the chest very, very long time now. And the one thing that you have to learn about the Fed is that it claims it will never be pushed around by the markets. So if the markets are advocating for 50 and they believe that they want to do a gradual approach, and that's where the consensus is, they will do a gradual 25 basis point approach just to show that markets are not pushing them around. But I, as one economist who is in a minority, think that we really should do 50 because it's time to get back to a more neutral stance, and we're way above that now.
Do you think a 50 basis point cut, though, Bill, would send some panic across these markets that maybe the Fed knows more about this economy that we don't know, that maybe things are slowing down more quickly than thought?
That's always the pushback against the 50, and I would have said that's true about 2 or 3 weeks ago, but right now the markets have so priced in 50, in some ways they'll be disappointed by anything less than that. So I don't think there'll be any sense of the Fed knowing something that the markets don't know. In fact, they're going to be pushing very hard for 50 and getting on with getting back to neutral, which is really about 200 basis points away.
Okay, well, Bill, so let's talk about that concept. The notion that the Fed is behind the curve could mean a wide array of things, right? It could mean the Fed is 1 or 2 meetings behind, or it could also mean, to the other extreme, they're not nearly close enough to prevent a catastrophe. How behind the curve do you think the Fed is?
There's no way the real economy is on a knife edge going toward catastrophe. There have been no layoffs in the U.S. economy, even though the unemployment rate has risen from 3.5% to 4.5%, and that's because more and more people think it's a good time to look for a job. And as far as inflation is concerned, the latest data points and the whole series of data points that the Fed has received and has been waiting for all this time has really put the nail on in the coffin about inflation resurgence. So right now we're in that very sweet spot where the Fed has a lot of optionality. And as an economist, what says what the Fed should do is 50. As an economist who's trying to say what the Fed will do, it's likely going to be 25, just to show they're not getting pushed around by the markets.
Bill, what would lead to something that would worry you in terms of the downturn in the U.S. economy? If it's not inflation, if it's not the jobs market, is it going to be the consumer that we have to watch out for?
Absolutely. In fact, if there's any weak spot in the U.S. economy at all, it's where consumption is coming from. About 40% of consumption is being done by about 25% of the population. That's because even though we've had a tremendous amount of job growth, the jobs that are being created have really lower and lower income. They're in hospitality and leisure. And you'll find that households are having to get 2 or 3 jobs just to make ends meet. So it's really the very rich that has savings, especially capital gains in the stock market, that is accounted for most of the savings. And the stock market is owned by the top 10%. 70% of the stock market and pension funds are owned by the top 10% of the U.S. population. And if you add another, the 40%, that accounts for about 3/4 of the, almost 90% of all the stock and assets that are owned by the U.S. Consumer.
Okay, well, the prospect of I think 2-part question. Do you think the U.S. could enter a recession by the end of next year? That's one part, because that also is at around the same timetable where Fed fund futures see the end of the easing cycle. And how deep do you think this easing cycle needs to be, Bill?
It's inevitable the U.S. will enter recession, but to time it, to call it within the next year, I think is a bit of a stretch. The data so far have been very strong. As I said, the weakness that we see is in the share of consumption that's in a smaller and smaller base. But we also know that conditions, as the Fed is easing over the next year, will be helping the interest-sensitive sectors, especially housing and investment, and it'll let people be able to feel a little bit more comfortable about spending. So I think we are in a pretty good shape, and the prospects of a recession, I think, are pretty low going forward.
Bill, you've been traveling around the region. As you mentioned, you were in Korea, now you're in Singapore. What are conversations like with people on the ground right now? Is it all about central bank policy, or are you hearing more fielding other questions right now?
there's an obsession about what's going to happen to the U.S.-China tensions vis-a-vis trade policy, especially for countries here in ASEAN, because I think that there's a clear sense now that, and I'm really impressed that the Asians have sussed out that Trump means more bilateral deals, and Biden-Harris is a continuation of these multilateral deals. And where the countries like Singapore and Korea and ASEAN will fit and how they will change their strategic trade policy will depend upon who's in charge and what kind of deals they'll be struck. And I think a lot of countries are looking forward to more bilateral deals because that's where they can get customized, tailored trade policy that'll be appropriate for both sides. And there's a lot quicker to do than the multilateral trade deals.
Right, and Bill, speaking of trade policy, I mean the other angle to that story that we over obsess about as well is, China's been exporting its way out of the economic doldrums right now, and there's a notion right now that external demand, particularly out of the U.S., might start to weaken as the economy softens there. Do you see trade policy tightening against China?
It's unfortunate that China's countercyclical policies have been so ineffective, and that's because they've been shifting their emphasis more and more onto the supply side rather than the demand side, where we really need some relief. President Xi has an aversion for direct household transfers, so we have the sense where we have deficient demand, we have debilitating debt levels that prevent local governments from spending, and also dismal demographics that's holding back growth in the long term. So China really has a lot of headwinds to deal with, and the fiscal policy they put in place is the wrong place. The U.S. showed in the 1930s that supply-side policies are just not enough.
What do you want to see from the Chinese authorities then, Bill?
I think they have put in a lot of fiscal policies that are really quite good in the sense that they put in swap policies to try to swap out a lot of the local government debt to try to bring some relief to the local governments. They should do much more of that because it's the local governments that are able to actually spend and entice more investments. The other thing is the more of the private sector. So far, a lot of the boost has been to the state-owned enterprises, and President Xi has really emphasized new technologies, quality growth, but it's all coming from joint ventures with state-owned enterprises, and that's not the way to encourage innovation. Innovation has to be encouraged by the markets and rather than being state-led.
Bill, it's a pleasure to have you here in Asia. Bill Lee, their chief economist and executive director at the Milken Institute, joining us live from Singapore. Yes, and just given the backdrop of this, right, we're getting into this Fed day, and really what you're seeing is crypto is doing quite well. We saw the best day in more than a month when it comes to Bitcoin. You take a look at how things are going. We pare back a little bit of that rally, but certainly there's signs